Sergey, welcome to Real Vision.
Great to be here. Thank you for having me.
It's a pleasure to have you here. This is an interview that I've wanted to do for some time now. We first met, I guess, a couple of years ago at a conference in Brooklyn. We had a conversation where we talked about what you were doing, and I was just spellbound by it. And it's really a pleasure to have you here and to get you to have the opportunity to explain a little bit about what you do. So let's just jump in and get started. Starting at the very beginning, what are smart contracts and why are they so significant to the global financial system?
So smart contracts in the simplest terms from a user's point of view are math-based contractual agreements. And I think the way to contrast them is to think about brand-based contractual agreements. And this will highlight for people the notion of something called tamper-proofness and the usefulness of tamper-proofness, because a lot of the times blockchains are explained in these technical parameters of tamper-proofness and reliability and censorship resistance and immutability, and these concepts don't always transfer over to use cases. So the thing that I think is needed is an understanding of a contrast between how the world works today and how the world will work in a math-based agreement kind of world. So the thing that people maybe don't think about so much because it seems to be working or it works in certain cases and so it's good enough, is that the agreements they have around their bank accounts, their assets, financial instruments are really brand-based agreements. And what brand-based agreements are a logo. There's a logo on a building somewhere. Just like in the Wild West, the biggest building was the bank with the pillars, and everybody would, put their money in the bank with the pillars because it would have the really nice pillars and be really impressive, and it would be the nicest building, nicer than the church, right? And that was the brand-based guarantee that bank gave you in that kind of gold mining town, and things haven't really changed very much in reality over. I would even say hundreds, maybe even thousands of years where you basically have a brand-based guarantee, right? I have a logo. My logo represents an institution or an entity. My institution or entity has been around for X hundred years. And I guarantee to you on paper, on a paper document, that my relationship with you is such that, your assets or your financial product or the value you hold in my institution is within your control, right? Like you will be able to access it. You will be able to buy and sell financial products. You will have a savings account that you will always be able to access. All the money in your savings account, you can always access. All the money in a trading account, you can always trade and you can always liquidate it whenever you want. And like all these types of guarantees are foundationally based on a logo. They're based on, I exist for a long time. I will continue to exist. I'm guaranteeing to you that, this relationship that I manage for your value that you hold with me will function in a certain way, right? And so those are brand-based agreements. Now, what math-based agreements do is they basically say there is no brand, there is no thing that has existed for hundreds of years, and I promise you things will work a certain way in a paper document. There is just math. So there's cryptography and mathematics that guarantees at the level of physics and mathematics that you have a certain relationship with a certain asset, certain financial product, certain contract. If we begin to unpack this and we think about, what does that mean? Let's take Bitcoin as an example. The relationship that a user has to a Bitcoin, regardless of the value of a Bitcoin, regardless of the value.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
This and we think about, what does that mean? Let's take Bitcoin as an example. The relationship that a user has to a Bitcoin, regardless of the value of a Bitcoin, regardless of the value that a Bitcoin attains within the global market, is that they have something called a private key. So they have a cryptographically enforced way to sign and to mathematically prove that they have, and only they have, control over this digital good housed in this network of thousands of computers. And so I'll give you an example of where this really starts to make sense. So if you look at the debt crisis that there was in Greece a few years ago, you saw people only being able to withdraw 66 euros per entity and per person from an ATM. So whether you had a business as an entity or whether you had an individual, they could only withdraw 66 euros, right? You have similar situations in certain countries where things aren't going as well as they could be, and you have ATMs and bank withdrawals being locked up. What you also see in all those geographies is wallet registration numbers growing by 300, 400, 600%, because people basically realized that their relationship with a certain asset was not what they thought. They thought their relationship was very deterministic. It was very direct. It was on the level of physics and a certain amount of surety and guarantees. And what the reality is, it's very different. It's like insurance policies, right? People don't know what's in their insurance policy. Realistically, people that rely on brand-based agreements to underpin their relationship with their assets have that same level of counterparty understanding. Like people are universally surprised when, something goes wrong in a country and the ATMs get locked up, and they shift to Bitcoin, right? And the reason they shift to Bitcoin is it doesn't matter if you have $1 billion in Bitcoin. If you have that private key, if you have the mathematical proof in your hand to move that asset, there is no way that can't happen short of physics and mathematics starting to work differently. And so this is the unique difference between brand-based and math-based guarantees. And this difference actually goes much, much further than people think. And part of the reason that this difference is underappreciated is because, well, basically, while everything's working, everything's fine. That's basically how the global financial system works, right? Everything's working, so everything's fine, and you don't really need significant improvement for your assessment of counterparty risk, for your management of counterparty risk, because, everything's working. I can access my assets, I can liquidate them, I can do whatever I need to do with them, right? But let's say there's an unfortunate possibility that the global financial system is now in a direction where its underlying solvency and its underlying assumptions might result in certain issues where assets can't be accessed. Counterparty risk becomes apparent in how faulty it is as a way to hold value or hold assets. And this is where the uniqueness of math-based agreements, even in their simplest form, right? Bitcoin is like the simplest form of a math-based agreement. It's the first one, it's the simplest one, it's the most secure one, it's the most adopted one. But it is by no means the only one. And there are many other forms of math-based contractual agreements that have taken the form of other tokens, now are starting to take the form of DeFi, decentralized financial products. But what they all have is they fundamentally have this level of control and this level of transparency and counterparty risk assessment and mitigation that traditional financial markets don't have. And I think there's kind of a very important difference there that's going to become more and more appreciated as that problem surfaces. And then as the transparency of these smart contracts that work in these systems begins to get valued, you also see people composing them in very useful ways. So fundamentally, from a user's point of view, it's a math-based contractual agreement. From a technological point of view, it's basically a piece of code that represents an asset or represents ownership or represents a financial product. But this piece of code operates in a system of computers beyond the control of any one party. And it's beyond the control of the person holding the value. It's beyond the control of somebody who would want them to stop from liquidating their value or controlling their value. And that's the uniqueness of it. And then because you've now taken contractual agreements, financial products, and ownership, and you've turned it into little pieces of code, now you can have many, many smart people build all kinds of configurations of those pieces of code. And that involves creating an an ecosystem for that, which is partly what we're involved in. And then once you create that ecosystem of people being able to combine these little math-based contracts, these in the forms of pieces of code, you'll start to see an explosion of new financial products, new assets, just like you saw an explosion of what internet companies could do. Because once internet companies could compose little individual pieces of code into chains of code that interact with each other in meaningful new ways, you saw e-commerce, you saw Uber, you saw all these other kind of innovations that were really the composition of existing other pieces of code together in unique ways. And so you'll on the one hand get a system that gives people an ability to properly manage counterparty risk. And on the other hand, you'll get an ecosystem where people can finally compose and build financial products the way internet companies build web products at the same speed and at the same kind of usability that people expect from the web.
Yeah. There's so much there, but two things really have jumped out at me. The first is just how truly profound that shift is between a brand-based relationship, as you call it, some others might call it relationship-based, and physics and mathematics, on the other hand, being the true underlying bond between counterparties. And the second point that I thought was very interesting is how truly globalized this effort is, and you touched on that in a number of different ways. There are many people here who have been fortunate enough to grow up in the United States, whose parents and grandparents have been enmeshed in this system for 75 years, and they've never had a significant incident. They may have lost a job and had trouble paying the mortgage, but no one ever questioned the title on their house, and their bank account was always available. But that has not always been the case throughout the rest of the world, and I think it's crucial for people to understand how this is truly a global challenge and also a global movement that is moving to solve it. Sergey, to follow up on some of the points you made, you just described the case for Bitcoin, the case for what the underlying value of the technology is. But what specifically are smart contracts? What differentiates smart contracts from Bitcoin, for example? And how do smart contracts continue to extend the existing functionality of an asset like Bitcoin?
Sure. So smart contracts are basically code. They're business logic that define relationships between assets, between data, and outcomes, right? So they're just code and business logic, but they're code and business logic that operate in this unique tamper-proof math-based guarantee universe. So it's basically the difference. It's almost like the difference between, well, it's the difference I said, right? It's brand-based and paper-based. I promise I'll do something, and when a system says it's going to do something, physics forces it to do it. Right. And so it's basically code that operates in this universe. What it really does is it's an extension of what you can do with financial products in this universe, right? So if you have the math-based guarantee universe, and before you only had, let's generate a token, right? First really the evolution of this was first Bitcoin, right? And you had one asset, one ledger for one asset on one network of computers, only focused on that one piece of data. And that network is only interested in, hey, how do I maintain and secure this one ledger of ownership about this one asset called a Bitcoin? And I have thousands of computers doing that, and I have a lot of hash power and security assigned to that, and I'm securing this one ledger, right? So that was the beginning. And then you had an evolution where people started to say, well, hey, I want to apply this universe, this math-based contractual guarantee capability to other things. I want to tokenize art. I want to tokenize equity. I want to tokenize land. I want to tokenize, whatever I want to tokenize, right? I want to create a token, and I want to put it in this format, essentially for two reasons. The first reason is this math-based guarantee reason. And the second reason is because due to the internet, when I tokenize something in this format, this becomes globally accessible. So I can make a token that people can interact with globally. Instead of I make a token and I put it on some small platform and only that platform's kind of universe can interact with it, right? And that's part of the reason why blockchains and tokens have taken off, where Basically, even if one geography at any one point says, hey, I'm not into this. I'm not into this token thing. There's 15 other geographies that are into it. And then if one of them says, I'm not into it, well, they're not saying it at the same time, right? So even if one geography says, I don't like tokens, the other geographies are, either behind or ahead on their thinking, depending on how you look at it. And they're all saying, we're fine with this. And so there's still a global market for tokenization, right? But tokenization is not, it's a very simple smart contract in that what it actually does is it basically says, I'm going to generate a list of assets, right? I'm going to make a digital list of 1 million things, 1 million units. And then I'm going to track where those units go. I'm going to see the 10 units go to you and 10 units go to you and 100 units go over there. And I'm going to maintain a ledger that basically tracks who has what units. And I'm going to maintain that history of ownership. And that history of ownership is really what a token is, right? It's a token, it's a history of ownership. And then the token represents something. And that's kind of the story that people craft around what that token represents. Does it represent a house? Does it represent a piece of art? Does it represent a digital good of some kind or equity or whatever it represents, right? And that was the next evolution, right? And that evolution, we can thank Ethereum for that evolution. Ethereum did a very impressive thing where they took the space from, hey, you can only have one token or it takes you years to make a token, to, hey, it'll take you a day to make a new token.
Right.
And so that was the functionality that Ethereum enabled. It enabled the functionality of let's make tokens. And so because that functionality finally became polished to a certain level of usability while maintaining security, and that's actually an important aside here, that the point at which things in our space begin to get adopted and utilized is once they can be built by developers without the developers having to build the security. So once infrastructure creates enough security for the developers to efficiently generate things, that's when things get built, right? So first you had Bitcoin, it generated security, it generated Bitcoin. Then you had Ethereum, it generated security around making tokens, and it allowed people to generate tokens. So there was a big boom in token generation. And now that was a smart contract, but a simpler version. And now you're moving on to more advanced smart contracts where the business logic is basically saying the types of things that financial products in the real world say, right? Let's make a derivative. Let's make a futures contract. Let's hedge some kind of risk, against a market event or a real world event like weather. And these more advanced smart contracts, they are really the thing that, I've been working on for, I think, over 7 years now. And the thing that has got me into this space and got me very excited because it applies this math-based guarantee to such a large universe of contracts, whether that's insurance for emerging markets so that farmers can have crop insurance and be able to withstand weather events, and that allows them to continue operating a farm even though there's a drought or something, whether it's financial products or savings accounts in emerging markets where people wouldn't usually have a savings account to combat inflation, or even whether it's more advanced contracts within developed markets where you're properly managing the risk around transparency and mortgages and all these types of things, right? So I think that smart contracts are this tamper-proof, mathematically guaranteed contractual agreement, but they're mathematically guaranteed specifically because they're run in these networks of computers that are run in a very specific way. And this is what decentralized infrastructure means. Decentralized infrastructure equals math-based guarantees. Anything other than decentralized infrastructure means brand-based guarantees. And that's kind of, I think, the important mental leap for people to make in their understanding of why does this matter. It's because, and this is the problem, right? Like if I explained the internet to you by saying, hey, there's this cool thing called HTTPS, and it'll let you move around credit card numbers. And once you can move around credit card numbers, it's going to be great. Like you would sit there and you would go, why am I, what? HTTP, what? Credit card numbers, why? You would just be completely like, why do I care? But when you really think about it, that HTTPS enabled people to move credit card numbers led to e-commerce.
Right.
And e-commerce led to all of us being able to sit in our house and click a button and have things delivered to our house.
Right.
And so that's the connectivity between new infrastructure and new use cases that is not as simple as like, oh yeah, they released a new version of a phone and it makes a new interface where I can now order things in my hand, right? Like like that mental leap is shorter, right? It's like if people can order things from their hand, they will. Okay, that's a mental leap most people can make. To understand the history of infrastructure in web-based, network-based systems, and then extrapolate how that history evolves into new use cases is, that's not a natural leap for. So that's where I think there's this disconnect, that once people get past that disconnect and once they see math-based agreements and their value, and that decentralized infrastructure creates that, they begin to see value in that. And smart contracts are just the name for that. So they are the name for, like, if you had a choice, do I want a brand-based agreement where the insurance company might pay me out or might not pay me out? Or do I want a smart contract that guarantees me payment if something happens? Every rational actor would choose the math-based smart contract. And that's the guarantee that smart contracts have, which other systems don't.
Yeah. I guess we could joke a bit about whether humans in practice are in fact rational actors. But leaving that to the side for a moment, that framework of understanding the way these networks work, it brings us right to the present, which is the challenge of networks searching for a source of truth, the tautological nature of a relationship within a network, and to precisely what you're doing at Chainlink now. Sergey, tell us a little bit about what the background of the Oracle problem is and why it's so significant in this space.
Sure. So the Oracle problem essentially is the question of how do I unlock access to all the world's data for these math-based contracts. That's essentially the problem, right? And the problem exists because blockchains only know about what goes on within them. Blockchains only generate their own data and security and math-based guarantees about what goes on inside of them. And the only things that really go on inside of them are token movements, signatures from private keys, and a few other things. And that's a very important foundation that we need to have for math-based agreements to even live somewhere, right? So the math-based agreement and the logic of the agreement can live in this network of computers that are purposefully limited in their interaction with the outside world in order for the math-based guarantees to be maintained, in order for the security of a smart contract to exist at all. But what that does is it basically says, the only thing I can write a smart contract about is the thing that I have information about. And the only thing I can have information about are things within the walled garden, within the blockchain itself, which to our earlier example is tokens, right? Because blockchains need tokens in order to pay miners, in order to pay the computer systems that secure them. Tokens as a functionality are inherently built in. And so a token contract, it generates its own data. It generates a lot of token units, and it sends those units to different addresses. And all the data is encapsulated within a blockchain, which is why blockchains so far have been about tokens, even though math-based contractual agreements and guarantees can be applied to so many other things. What an Oracle does is an Oracle enables the logic in a blockchain to interact with external proof. So it enables it to know that goods have arrived, that a weather event occurred, that a market price has changed, that some contractual outcome somewhere has occurred. And I think the important nuance to understand here is that you can only write automated financial agreements. You can only write automated math-based contracts around things that you can prove, right? Because the math-based contracts are basically saying, I have proof something happened, and so I'm going to act on it. And so you could only really write a contract in that format around the things that you can prove. And so then the question becomes, okay, I want this math-based contractual format. I want more contracts in that format. How do I enable that, right? How do I achieve proof to the level that it can be considered math-based contractual agreement proof, that it can be considered so reliable such that it could trigger $1 billion payment about a weather event, or it could trigger a $100 million financial product, right? And so this is the nature of the Oracle problem is firstly, how do I even provide this data? But then secondly, the second order problem that we deal with, the harder version of the Oracle problem, is how do you prove that something somewhere happened in order to trigger something in this system? Because what you should seek to achieve, and we seek to achieve this once again through this decentralized infrastructure approach, is you should seek to create as much proof as possible that an event occurred. And the more proof you can create, the more automated you can make your agreements around that event. Like, for example, if I have 100 sensors all telling me that the weather or the rainfall or something is in a certain state, I have a certain level of proof that I can pay out an insurance policy.
Right.
And so now I can automate that payout of that insurance policy. And if I can automate the payout of the insurance policy, well, then guess what? I don't need a local legal system to enable insurance. I can have a parallel technologically enforced legal system that'll provide crop insurance to people on their phones in all parts of the world where it might have taken them decades to get crop insurance against droughts and weather events and all these things that impact all these people farming. So I think the Oracle is essentially creating definitive truth about the external world, and it's pumping that into another system that has definitive truth about a contract's state. And once you combine these two systems, you open up a world of implementations and applications for these math-based contractual guarantees,
right,
which change people's lives in the emerging markets and substantially change the way the global financial system works in the developed world.
Yeah. These are just fascinating questions. So many points, but the first thing that comes to mind is the technical challenge of synthesizing all of this data. To use a simplified metaphor of the point that you were making, if it's a smart contract that is a claim due to weather, for example, if there's $1 billion at stake, one might plausibly assume that a bad actor could go and stand over a sensor with a watering can and fake the data. But when you're drawing the ultimate source of truth from a network of hundreds of sensors, you can build in ways of analyzing that data to make sure that it's accurate and to provide true falsifiability. What are those challenges like, and how do you think about them at Chainlink?
Yeah, I mean, it's a very kind of complicated and fascinating problem. I mean, we're very lucky to work with some of the best people in the academic world and the security research community on this problem. So it's a novel and very important problem, because what you're essentially saying is, how do I make computer systems that are provably independent from each other and ungameable and incorruptible? How do you get them to agree and prove that something happened? And then how do you connect the world's data into such a system to prove that things are happening a certain way? Whether those are claims about political events, whether they are claims about weather, whether they're claims about price data. And so there's a few nuances there. One of the nuances is proving that data came from a specific source, which is something that we work on very actively, and we have a lot of approaches, both cryptographic and kind of software-based, that we apply to that. Another dimension is guaranteeing that the data will be delivered to the smart contract system. So you need to prove that the data came from a specific source. You need to have a capacity to include many different sources, or as many sources as you can, and be able to weight those sources appropriately,
right,
to define what a proof of definitive truth looks like about a certain set of events, leading up to a definitive truth about price or a definitive truth about a weather event. And then you also need guarantees that that calculation will happen in a tamper-proof way, so it'll happen in a math-based way. And then you also need proof that the math-based guarantee that you've generated from many sources, and that's computed in a math-based provable way, is then going to be delivered correctly to the contract. Because that's where you need one math-based system in the form of an Oracle network to interface and send data to another math-based, contractually guaranteed system in the form of the smart contract. right? And so like basically oracles and smart contracts make what we call universally connected contracts, right? They're the more advanced version of smart contracts.
Right.
The solving of this problem actually needs to happen on a case by case basis, and what you really need is a highly flexible system that can allow the inclusion of various data, can allow the application of various forms of computing and proving that the data does represent reality, and then various ways to deliver that data, that proof, that definitive truth into the systems where people want to consume it. So this means you need such a system to be able to interact with the world's data. You need it to derive and generate definitive truth that's cryptographically proven and guaranteed. And then you need it to be able to deliver that into the various blockchains, layer 2 systems. And in some case, interestingly now, we're seeing actually web systems also want such a level of definitive truth. So I actually think the counterintuitive and interesting thing is that once you develop a level of definitive truth about events that meets this high standard, there's actually many more use cases than smart contracts and blockchains that want that level of assurance that an event occurred. Yeah. But it's smart contracts and blockchains that have that really high standard to begin with. So if you build a system that meets their extremely high standard, then offering that same level of definitive truth to other systems with a slightly lower standard is going to be kind of easy because you've already met the higher standard.
Yeah. It sounds like you're solving not a problem, but a stack of problems, because you have all of these different hops, whether it's the sort of authentication, non-repudiation at the sensor level, validating and associating it with a particular event, associating it then with the contract, tying it into the network. It is a lot of different hops along the way that need to be solved.
Right. You're basically trying to take the non-deterministic, probabilistic, unpredictable world. You're trying to feed it through a system that creates what we call definitive truth, and what we consider to be essentially the level of proof that a smart contract can rely on to trigger itself. And then you're feeding that into all of these various environments. So you need to solve a few fascinating problems and some of them we've solved, and some of them we're on the way to improving the solution to, and some of them for the more advanced versions of an Oracle network like Chainlink we're in the process of solving. And we recently, launched a big research program, and they're like this space, the incremental improvements in this space, they come out of people taking genuine computer science innovations built on standing on the shoulders of giants, and composing those with their additional innovation into a new infrastructure capability. And so once that happens, you see a kind of explosion of usage and new smart contracts being generated from that. And it's that initial I think that initial spark of a new type of smart contract that we've now started lighting in the form of DeFi and in the form of enabling a lot of DeFi and a lot of different contracts to come into existence. And I think as we continue to research and release new additional ways for this new Oracle network form of computation to function, you'll see more and more, for example, as we put weather data, you can have insurance. As we put price data, you can have financial products. As we put something called proof of reserve, where we prove the solvency of an underlying asset as collateral, you can now use that collateral in a financial product. And so as we incrementally solve those problems, you'll see more and more infrastructure appear, and you'll see more and more use cases come out of those incremental additional variations of this infrastructure.
Yeah. Sergey, when you talk about definitive truth, what does that mean? And I don't mean it in an existential way, just from a game theoretic perspective. What is the level of assurance you need? Do you think about it in terms of confidence interval? What's the number of nines that you need to believe that something is in fact true?
So I think at the end of the day, it happens on a use case basis, and it's kind of a spectrum of the best that you can get. And then it's a risk assessment of how much of this is how much is this a definitive truth, and how much value can I tie to that? right? So we have networks right now of 21 nodes, 21 independent tamper-proof nodes that are pulling data from 10 different data sources. And so those data sources prove to a certain degree of definitive truth that that's the case. I think definitive truth has two parameters to it. In my opinion, it has a parameter around tamper-proofness. It has a parameter around that people can't manipulate the data to change the outcome of what the truth is. So you actually, in my opinion, need an Oracle network. You need a system that has incorruptible, independent computing agents to come to agreement about what definitive truth is at all. So you need a level of tamper-proofness to arrive at a definitive truth, in my opinion. And then from there, you start to look at what is the dispersal of data sources, what is the dispersal of proof,
right?
And then there will be different thresholds, right? And it'll be different in different industries. In some industries, it'll be, we had 5 data sources all say to us that this is the case. Those data sources are globally distributed and they're all kind of independent of each other. And I know the data sources are incorruptible. I know they're independent of each other. So kind of at a certain point, when you have enough people telling you this is the definitive truth of the weather at this time on this day, that is the closest you're going to get.
Right.
And that's really what the system will be able, or already does in many cases, is it gets you to the closest you can to definitive truth about certain matters.
Right.
And those matters are prioritized right now against smart contract types, right? Like, so people want price data to make decentralized financial products. So we create definitive, framework Chainlink is a framework that gets composed into Oracle networks that generate that definitive truth for that set of contracts about that set of financial products, such as derivatives or lending or whatever. But we have others where we have Oracle networks that generate definitive truth about weather events that on production today are actually executing insurance contracts for emerging markets and developed markets. And so that's another version of definitive truth, and their standard, and that's actually what Chainlink is meant to do. Chainlink is meant to allow people to define, firstly, the user can define in a service agreement what they consider to be definitive truth and what their threshold is, and then they can require that of the network, and then the network can be composed of the node operators and data sources that go on to define definitive truth to the standard of that user and of that contract.
Right. So it's a functional and operational definition, and it's agreed upon in a service level agreement. But what makes this unique from a traditional agreement, for example, with an insurance company, is that it's public, it's transparent, and it's verified by the laws of math and physics.
Right. And the service level agreement, just so you understand, it's not a paper document. You can have a paper document attached, but the service level agreement happens on chain. So you actually have an on-chain commitment from a system saying, I'm going to deliver data to you at a certain frequency, at a certain quality, for a certain time period. And then, so you have the commitment and you have the data also being delivered on-chain. So this means you have a lot of proof about whether certain oracles or certain compositions or ensembles of oracles or nodes has been successful at delivering certain types of data, because their commitment is memorialized and their delivery is memorialized in this math-based system. And all the economics that flow to the node operators is enforced in such a math-based system, such that if they don't deliver the data, they could suffer a penalty, or their fees could not be released to them, or any number of other kind of dynamics, right?
Right.
And so it's really this fascinating question of how do people compose, how do people have a system that composes definitive truth for them on a use case by use case basis? And also, very importantly, if the value in the contract increases from 10 million to 100 million to a billion, perhaps you get to a point where you say, hey, I want more definitive truth. I want more proof. I'm not comfortable with just having 7 nodes asking 3 data sources or 5 data sources. I want 70 nodes asking 10 data sources, or I want even more, right? Because now what's at stake is greater.
Right.
And I want to scale my relationship to definitive truth about the real world in a way that relates back to the value controlled by such a system.
And smart contracts can build that scaling in programmatically. So as the value scales up, you can have a scaling factor on the source of truth side as well.
That's right. The smart contracts can basically say, like, once I hit this threshold, I need to go request 3 more data sources of AAA quality, and I need to have at least, I need that validated by at least 15 more nodes of, this quality level. And you're absolutely right. The system will get to a point where people will be able to dynamically request more reliability, more proof, and that'll scale with the value secured. And really, if you think about it, this is how you would, we're really talking here about making an automated world of contractual agreements. And then the question is, how can you make that automated world? And I think the answer is when you can rely on all the automated systems responsible for controlling the agreement. And one of the key parameters, or in many cases, the starting point of that is what's going to trigger the system. And so until you have that definitive answer of like, this is the right answer to trigger the system, you can't exactly make the perfect automated contract.
Right.
You will always have to have people in the mix, or you always have to have some system that's and that's not to say that every contract on the planet can be automated. I can't make an automated contract about I painted your house the right color blue. Like I can't, there's always, that's another thing people kind of misunderstand is they think we're saying, hey, every contract ever, forever, did you like the TV you bought? Did it meet your expectation? Like we can't prove that with data.
Right.
But there's a huge amount of things and that can be proven with data, and the amount of them is only going to increase. And the global financial system and even emerging markets are all going to want and need a contractual system that functions in a provable, transparent, and efficient way, almost, and really importantly, actually, regardless of what's happening in their local legal system. So the other fascinating thing is you now have a parallel technologically enforced legal system that people can rely on regardless of international kind of dynamics or local governance structures in a certain economy. And that's actually proven by the tokenization movement and its global nature, is that people all over the world can participate and utilize this infrastructure without any consideration about the legal dynamics of any one country or any one geography.
Right. And that's fascinating as well for the reasons that we were talking about earlier about the international system. And, people who've grown up in the United States were generally accustomed to the rule of law, to the idea that contracts are enforceable. But the idea that you could extend that through the math and physics-based proofs to the entire world, it potentially opens up a world of possibility for international applications.
Right. International applications is one thing, right? It doesn't necessarily, if you have a parallel technologically enforced legal system that can guarantee to you that if you conduct some kind of agreement with somebody on the other side of the planet, right, and it's all driven by data and it's all completely memorialized and clearly guaranteed and clearly proven to work against the parameters you want, you don't need to care about their local legal system. You don't need to think about that or the relationship that they have with whatever other legal system. You can now, conduct global trade, global economic transactions of all kinds. The other thing that it does is it actually enables all kinds of startups and insurance companies and other financial firms to sidestep non-functioning emerging market legal systems. So what it allows them to do is to say, look, if you're in a country that people have a phone, which is basically every country now, and that phone has access to the internet, we can offer you a savings account. We can offer you crop insurance. We can offer you access to all of these financial products that help you combat inflation, help you insure yourself against all kinds of risk. Because the relationship that we have with you as a user is not based on your legal system. It's based, and the user doesn't want that either, right? There are so many places in the world where the legal system simply doesn't enable certain types of economic activity. And I think that a parallel technologically enforced legal system is going to just give people a better alternative. I think this technology is in the process of getting polished, just like many other technologies that leapfrog in emerging markets get polished. And once it gets polished to a certain threshold where you no longer need to be an expert, like once the security and ability to build with this infrastructure is so polished and baked into it that any developer anywhere can just spin it up and build a financial product or insurance company or savings account, you will see the same thing that you saw with telecoms and cell phones, and the same thing that you saw with the internet and access to information. You will see that for contractual agreements through this format.
Right. It's we often talk about scaling problems, for example, in Bitcoin with the method of medium of exchange function. But it strikes me that with smart contracts, with oracles, there's potentially the reverse effect. There's potentially a kind of Metcalfe's law effect, where when the number of sensors in the domain set scales linearly, the ability to verify things will scale geometrically, so that there's a nonlinear relationship. And as the system scales up, you get a greater level of truth.
Yeah, I think that's absolutely the case. I think there's two dynamics. I think one dynamic is where we already see many users using the same data sets that other users use, and so we don't need to launch the same network again. And as we launch every additional network, we see multiple users now showing up and using Oracle networks about specific pieces of data. And the fees from those users go to support that Oracle network. So eventually you arrive at a place where as more users use a certain Oracle network or data resource, their fees, they don't go to us, they go to the node operators. And so as more fees begin to accrue around a single Oracle network for a single piece of data, that is the place that has the most fees to get the best quality data, the best quality nodes, and grow into the best resource for data. And we're already seeing multiple users simply sign on and start using existing Oracle networks where they contribute their user fee. That user fee is then used to buy more data for that network, more nodes for that network, and therefore grow the security and usefulness of that network on the basis of usage by users. So the more users that use that network, the more its security grows, because the more user fees are then distributed into that network's use of data, that specific one network for that one specific piece of data, right? And then the second dynamic that I think is very important is the purchasing power of data that these systems will have. I think what'll happen, and you already see this happening with insurance companies, actually. You already see insurance companies going to some of their customers and together with a sensor partner implementing sensors into the infrastructure of the customer, of the insurance company's kind of policyholder, for them to have sensors which then feed data to the insurance company, for the insurance company to offer them something called parametric insurance. And the person that subsidizes this, in many cases, the insurance company, because they actually thrive on being able to predict risk and predict what'll happen with their policyholder. And so I think once substantial amounts of value begin to be triggered by a network of nodes that rely on a multitude of different data sources, the value that those data sources provide will also scale. And then you'll be the system will be in a position to say, we have another $100 billion coming online to be secured. And the people bringing that on, they're bringing on, another $1 million in user fees. We need to now distribute that $1 million in user fees to better secure our specific network for this specific data. Guess what? We now have $1 million in user fees to go and get people to launch more sensors, go and get people to generate more data. And I've already seen that happen in the insurance industry. Everybody's completely happy to generate more data as long as you pay them. And as long as you trigger more value with data, you will have more user fees, you will have more economics to drive towards paying for data. And so that eventually leads to a place where data providers, I think, eventually are making the majority of their revenue from triggering systems through something like this.
Interesting.
I think eventually everybody's going to want, like if you had a choice between reliable data and unreliable data, what would you choose? Would you just choose unreliable data and say, hey, it'll be fine, trigger my $1 billion and my whole company's existence depends on this data being correct? I think that's the nuance. And the smart contract use cases, the DeFi users are just the first hypersensitive group to that reliability level, because they have to provide a certain reliability to their users. But eventually that level of reliability will be superior. It will be superior to any other level of reliability for data that triggers high value things.
Yeah. You shifted gears a bit there. We've talked a lot about the theoretic component of this, and you shifted gears a little bit to the practical and where we are. I'm curious, what's the state of play today, right now, with the implementation of these solutions at Chainlink and elsewhere in the world?
I think what I'm seeing now is something I've been waiting for many years, and something we've all been working towards in our industry for many years, and that is truly really exciting. And I feel the beginning, the true beginning of what people call fourth industrial revolution, or what people call a reimagining of the global financial system, or the world of contracts in general. And what I'm seeing is contracts that do something other than make tokens. So they don't make a token in order for people to buy and speculate on a token. They make a contractual relationship between a user and the economic outcome of the contract. And a very simple, straightforward example of that is lending, is the ability for users to put an asset into a lending protocol and receive an interest rate in return, and receive interest on the asset, the collateral they ended up putting into that lending protocol. And after 7 years of developing smart contracts and 10 years a number of years. In any case, a number of years in the blockchain industry, you basically see you're now seeing people make financial contracts in this format that are about monumental, kind of foundational pieces of the global financial system. Like, how do I earn interest on an asset, right? What do savings accounts do? What do bonds do? They provide a yield. Now you have contracts in this format providing people a yield, and they're doing it amazingly well. And they're growing literally from below $1 billion to over $10 billion in less than a year of collateral and value secured in these systems. And that rate is only increasing. And they're able to generate returns for their users of anywhere from 2 to 8%. Or actually far more in certain cases. It just depends on if you believe that rate of return is going to persist. And so what you're seeing for the first time is you're seeing people go from let's make a token and sell the token to let's make financial contracts about derivatives, about lending, about insurance. And let's present those financial contracts to a user base, which right now is a limited user base because you need to have something called a private key. In order to participate in these contracts, you need your assets in the crypto format, in a cryptocurrency or a crypto token format, which is a universe of about $350 billion. So even there, I think you can see, hey, here's $350 billion of a universe of assets in a certain format. And here's about $10 billion in this set of financial contracts where people are able to earn 2%, 4%, 8% interest. And once again, the uniqueness of this is that it's not about speculation. It's about, here is a financial contract that works better. Whereas the standard normal financial system might give you 0% or 0.05% interest, or if you're lucky to get it, 1% interest or something, right? And that's probably going to persist, and inflation is probably going to happen pretty heavily. This ecosystem can give you anywhere from 2 to 8% interest consistently, as long as you take your assets and you turn them into a crypto format. So what does that say, right? And also you see a consistent flow of new collateral and new value into this format, which then creates a cycle of generating even more returns for that ecosystem. So I think the unique thing that you're really seeing take off this year, and this is why DeFi is exciting, is DeFi is the start And really the people building this to me are amazing, kind of the pioneering people like Aave and Synthetics and Yearn and Nexus Mutual and a lot of these other amazing users of Chainlink. All of the ones I named are actually enabled by our oracles to do this by having high quality data trigger all of these financial contracts such that they can't exist at all because they have high quality data triggering them. I think we're kind of at the beginning of this. If you just do the basic arithmetic, if there's 10 billion in DeFi now, and there's 350 billion that could be in DeFi, and you're looking at 2 to 8% interest rates, you have two serious forces pushing things into DeFi. The first serious force is who doesn't want 2 to 8% interest on an asset?
Right.
And then the second serious force is eventually the consumer landscape, Robinhood or whoever is going to figure out everybody wants interest yields. If all I have to do to get somebody interest is take their dollars and turn it into a stable coin and put the stable coin in a lending protocol, and I can suddenly give them 4%, a 4% savings account. I mean, how do you think that's going to play out in the consumer market? And how much value, like, why on earth wouldn't trillions of dollars in value eventually flow into an environment like the financial markets don't care. Like they don't care what infrastructure they use. They don't care if their 4% yield comes from a database running X software or Y software or a blockchain, right? The important thing is two things. The important thing is that they will actually get returns from a financial product. And the second thing that's moderately important now, but I think is probably gonna rise to a fever pitch eventually, is gonna be their ability to manage counterparty risk in relation to the financial product in which they hold value.
Yeah.
And both of those properties are gonna be uniquely well represented in this DeFi smart contract math-based guarantee format.
Yeah, and especially in as we're filming here in October of 2020, 10-year Treasury note yielding about 75 basis points. So there's just no yield to be found in the traditional fiat capital market system. So it is a compelling proposition. Sergey, I feel like you anticipated my final question with your last answer. But as you look ahead over the next 1, 3, 5 years, what do you see the practical state of play evolving toward in this space?
I think there's a slow scenario and there's a fast scenario. So the slow scenario is that this technology continues to get better. The infrastructure, like what we make, continues to improve, continues to enable people to build better and better financial products. And those financial products continue to make their way in more usable and usable forms into the hands of more and more users. Whether those users are crypto users that have a private key and a hardware wallet, or whether existing web systems figure out how to give their users access to crypto systems, the way that you're now seeing many people seeking to give their traditional web users access to Bitcoin, right? And so I think there's a slow case where the technology improves, the unique benefits of the technology, the yield generated by the contracts, the transparency and counterparty risk all becomes highly, highly sought after by an astute group of early adopters that continues to grow. And that will continue on the merits of the system. And these systems already have so much value in them that if good startup teams come in and build good products, they will become successful. They will get funding. And so this ecosystem now has reached a critical mass where slowly it will continue to improve and make better and better versions of itself and get polished to the point where it'll make its way into the global financial system, right? Probably through interfaces like banks and web interfaces and all the interfaces that also don't care where they get yield. They just care that they do, and they just want to if their users want to consume Bitcoin, they'll give them Bitcoin. If their users want to consume DeFi products, they'll give them DeFi products, right? And so that's the slow case. And I think a lot of the DeFi protocols coming into existence now are going to be the ones that those existing web systems end up giving people access to. So the protocols coming into existence now for lending, for derivatives, for all these other things are really forming a foundation that I think is underappreciated. and is going to form the foundation that, banks and all these other people, they're not going to want to rebuild this, and they're not going to even be able to handle it, in my opinion, in many cases. They're just going to use existing protocols and systems and infrastructure like they always do, because they're not software companies. They're institutions that seek to give people financial products.
Right.
That's the slow case, right? And the fast case is kind of a bit of a scary world, where if the global financial system goes through a bit of a shakeup based on the underlying solvency and the underlying counterparty risk of that system, you start to find. I think the scary version is kind of scary because it starts to call a lot of things into question. It'll start to call into question the solvency of institutions and things that have been around for hundreds of years and have been solvent and have been relied on. And, insurance plans and banks and all these types of things. And all of these things get uncovered when global financial systems simultaneously hit a really big roadblock, like when reality gets corrected against underlying value, right? And that's when everybody's worries about solvency and counterparty risk and transparency about how these systems work, they suddenly go from zero to fever pitch, right? To 90% of people's attention and bandwidth. You have all kinds of working groups, assessments, hearings, decisions, and there's literally like a year where people have political capital to make changes and to enable a better system, right? So if there is a global financial system shakeup, and there is a big sensitivity to counterparty risk that comes out of that, then I think I can't imagine the system people would say is better than this.
Yeah.
This system is purpose-built. In fact, Bitcoin itself, many believe, came out of the financial crisis,
right,
in order to solve problems like this. And so I think that the purpose-built counterparty risk management, transparency, immutability properties of blockchains are going to become extremely in demand in the scenario where counterparty risk and solvency and a lot of these questions become top of mind.
Yeah.
And in that fast case, you see everybody, banks, asset managers, all kinds of financial institutions basically realizing that if they don't provide math-based guarantees, they will lose business. Yeah. Because think about it, if everybody's brand-based guarantee suddenly diminishes to near zero value, how do people compete?
Yeah.
Right. If some institution over there that somebody had money in becomes insolvent, or their counterparty risk goes sideways on their users, and then somebody is selling you on the same idea of like, my logo's good, my logo's been around 100 years, and you just heard about how something that's 100 years old is no longer solvent. It's like gibberish. It's not a pitch anymore. It's not a value proposition. It's almost a negative, right? Like the fact that somebody's telling you that is almost like they don't understand what the world is about. And so everybody, I think, in that world is going to realize very quickly that brand-based guarantees, aren't their competitive advantage anymore. Their competitive advantage is now math-based guarantees. And guess where they're going to get their math-based guarantees from? Guess what the fountain of math-based guarantees is going to be. It's going to be blockchains and smart contracts and oracles. And if they're going to want to even retain their current user base, you'll just see it on quarterly earnings calls. One quarterly earnings calls, we have math-based guarantees, we're going to win the market. Next quarterly earnings call, every single other bank is like, yeah, we're going to have it. By the third quarterly earnings call, if people don't have it live, people are going to be wondering what's going to be happening with that bank or institution. And I mean, if that's the world, then this technology, in my opinion, gets adopted overnight.
Yeah. Scary and fascinating at the same time.
Right. It is kind of scary. The world the world we would have to get to for that to be a scenario, for things to have to move at that speed, is indeed unfortunate and frightening. But It could happen slowly. So it can still happen slowly. I still think that, or it could happen in different parts of the world, right? There could be parts of the world where, like, you can see in certain emerging markets, people are starting to use stable coins because their local their local currency isn't tokenized. Their local currency has hyperinflation they can't combat, and yeah. So I think we'll see probably parts of the world where we have the fast case, hopefully not the whole world, and we'll have parts of the world where we'll see the slow case happening. So in either case, it's spent a lot of time on this, very excited by it, still very convinced. Let's put it that way.
Sergey, thanks for joining us.
It's my pleasure, Ash. Thank you for having me on the show. I appreciate it. Thank you.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.